In the last few episodes, we have built two important pieces of our code to cash foundation. First, we understood the business process itself. Then, we looked at the different systems and technologies that can enable that process. But we still are missing one extremely important piece: the people. Because ultimately, systems don't run a code to cash process by themselves. Behind every quote, contract, order, invoice, and payments, there are different teams making decisions and performing activities to move the transaction forward. And here is what makes this particularly interesting for us as consultants. Every one of those teams can look at the exact same customer transaction through a completely different lens. Welcome back to the Code to Cash and ARM Playbook with Anand Ramakrishna, a Go to Mentor series. Let's go back to our startup. They have hired 20 new employees and approached our technology supplier looking for 20 laptops, 20 docking stations, 20 antivirus subscriptions, a 3-year extended warranty, and premium IT support for a recurring fee. One customer, one transaction, but watch how many different teams may become involved in getting this transaction all the way from quote to cash. Let's start with the most obvious one: sales. The salesperson is probably thinking, how do I win this customer? They need to understand what the customer is trying to accomplish and put together the right commercial solution. Perhaps the customer originally asks only for the laptops, but through the conversations, sales discovers that these are 20 remote employees. Now, docking stations become relevant. They need endpoint security, so antivirus subscriptions become relevant. They want protection beyond the manufacturer's standard warranty, so an extended warranty enters the deal. And they don't have a large internal IT team, so premium support may also make sense. Sales is therefore helping turn the customer's requirements into a commercial opportunity. They are managing the relationship, progressing the opportunity, negotiating with the customer, and trying to win the business. That is their lens. But sales does not simply invent whatever product and prices it wants. Somebody has to determine, what does our company actually sell? That's where teams such as product management and pricing may enter the picture. Product management may define the commercial offerings. Which laptop models do we sell? Which warranties are available? What does silver versus gold versus platinum support actually include? Which products can be sold together? Pricing teams may help establish list prices, pricing strategies, discount structures, or other commercial rules. So, product management may be thinking, are we offering the right products and services to the market? And pricing may be thinking, how should those offerings be priced so that we are competitive while still protecting profitability? Those decisions eventually become the rules sales works within. Now, suppose our salesperson has configured the solution and wants to give this customer a 30% discount. Can they simply do that? Maybe, or maybe not. This is where sales operations, revenue operations, or deal desk may become involved. Perhaps sales can discount up to 10% without needing any approval. Between 10% and 20% might require a sales manager approval, and anything beyond 20% might require a deal desk or finance approval. Why? Because the organization wants sales to move quickly, but it also wants deals to be structured consistently and profitably. Deal desk may look at our transactions and realize we are giving away too much margins here, or the customer is asking for non-standard payment terms, or maybe we are combining a 3-year subscription commitment with a special discount that needs additional approval. So, while sales is asking, how do I win this deal? Sales operations or the deal desk is asking, are we structuring this deal correctly and according to our commercial policies? Same transaction, different perspectives. Now imagine the deal looks great and the customer asks for a net 60 payment terms. Think about what that means. We may ship thousands of dollars worth of laptops, activate subscriptions, start providing support, and then wait 60 days for the customer to pay us. Suddenly, another team has a very different concern. How confident are we that this customer is actually going to pay? That's where credit management may enter the picture. In some organizations, credit management is a dedicated team. In others, this responsibility may sit within finance or accounts receivable. Perhaps the customer has an excellent credit history and we are comfortable extending $100,000 worth of credit limit. No problem. But perhaps it's a brand new startup with very little credit history. Now the business might say, we will approve the deal, but we want 50% upfront. Or perhaps we'll give them net 30 rather than net 60. That's a completely different decision from product configuration or discounting. So, while sales is thinking, how do I win this customer? Credit management is thinking, how much financial exposure are we comfortable taking with this customer? Now, the customer likes the commercial proposal, but their procurement team says, before we sign, our legal teams need to review the agreement. Now the conversation changes again. Maybe our standard contract provides a certain level of liability protection, but the customer wants unlimited liability. Maybe our standard premium support SLA says we will respond within 8 hours, but this customer wants 4 hours. Maybe it's a 3-year agreement, but the customer wants the ability to terminate for convenience after the first year. Those aren't simply sales decisions, they are contractual commitments and risks. Legal and contract management, therefore, care about questions such as what are we legally committed to? What obligations are we accepting? What happens if something goes wrong? And are the negotiated commercial terms properly reflected in the agreement? Their objective isn't simply to close the opportunity as quickly as possible. Their job is to help the organization manage contractual and legal risks while still enabling the business to move forward. Excellent. The deal is now signed. But we have our favorite quote to cash problem again. The customer still doesn't have anything. Now, order management and fulfillment takes over a very different part of this journey. Order management needs to understand exactly what was sold and translate that commercial commitment into something the organization can actually execute. For our customer, that means 20 laptops and docking stations need to be physically fulfilled. The antivirus subscriptions need to be provisioned, warranties need to be registered, and premium support needs to be activated. Now, imagine only 12 of the 20 laptops are currently available. Order management and fulfillment may need to determine whether to partially fulfill the order, wait until all 20 are available, source the remaining 8 from somewhere else, or communicate a revised delivery date to the customer. That is an operational problem. So, order management is thinking, what exactly have we committed to deliver and what needs to happen to this order? Fulfillment is thinking, how do we actually deliver what we promised? Once products and services begin becoming billable, the billing team enters the picture. And their perspective is different again. They need to translate the commercial agreement into an accurate invoice. The laptops and docking stations may be billed upfront. The antivirus subscriptions might be billed annually. Premium support might be billed on a monthly basis. Perhaps the vanity has its own billing schedule. Now, imagine sales negotiates net 60 instead of the company's standard net 30. Billing needs to know that. Maybe a credit was promised. Billing needs to know that too. Because if the invoice does not match what the customer believes they agreed to, we haven't simply created a billing problem, we have potentially created a customer dispute and collections problem downstream. So, billing fundamentally is asking what should we invoice, how much should we invoice, and when should we invoice it. But as we have said throughout the series, an invoice is not cash. Suppose billing generates a $40,000 invoice with a net 30 payment terms. That 40,000 is now money the customer owes the business. That's where accounts receivable, the AR team, comes into picture. Accounts receivable needs visibility into what is outstanding, what has been paid, and what is becoming due. Then 30 days arrives. Maybe the customer pays the full 40,000 amount. Great. The payment can be applied against the invoice and the receivable cleared. But perhaps the customer only pays 30,000. Now, AR needs to understand why there's a $10,000 difference. Maybe it's a partial payment. Maybe the customer disputes part of the invoice. Maybe a payment was received but wasn't properly matched. So, accounts receivable is essentially asking, what does this customer owe us and have we actually received it? Now, suppose day 30 arrives and the customer pays nothing. What happens next? That's where dunning and collections come into picture. Dunning is the structured process a business uses to remind customers about the amount that are becoming due or are already overdue. Perhaps the customer receives a reminder before the due date, then another after the invoice becomes overdue. As the invoice continues to age, the communication may become increasingly urgent. Eventually, the account may be escalated to a collections specialist. But here's something important. Collections isn't necessarily just calling the customer and saying, please pay the invoice. Maybe the customer says, we are not paying because you billed us for 20 laptops, but we have received only 12. Now, what looked like a collections problem may actually be a fulfillment or a billing dispute originating upstream. That's why quote to cash is so interconnected. Collections may need to work with the billing, sales, customer service, or order management to resolve the underlying issues before the customer will pay. So, billing asks, what should we invoice? The accounts receivable asks, what does the customer owe us? And the collection asks, why haven't we been paid and what needs to happen to collect the cash? And then we have the finance and accounting team. They are looking at exactly the same customer transaction through yet another lens. The invoice created an accounts receivable balance. The payment eventually clears that receivable. Taxes may need to be accounted for. Credits and adjustments may create additional accounting entries. And all of those transactions may ultimately need to flow into the general ledger and company's financial statements. Finance, therefore, cares deeply about accuracy of the information flowing through quote to cash because a problem that starts upstream can eventually become a financial reporting problem downstream. A wrong price can create a wrong invoice. A wrong invoice can create a dispute. A dispute can delay collections. And incorrect transactional data can ultimately result in incorrect accounting. That's why finance isn't sitting somewhere completely separate from quote to cash. Finance is one of the major consumers of the transactions quote to cash creates. And for some businesses, there's another stakeholder that becomes especially important: revenue accounting. Imagine our customers pay upfront for a 3-year support service. We received the cash. We may even have invoiced the entire amount. But here's the question: have we actually earned all of that revenue yet? Maybe not. Revenue accounting needs to determine how and when the revenue should be recognized. How much can be recognized now? How much needs to remain deferred? And should the remaining revenue be recognized over the next 12 months, 3 years, or based on when the specific performance obligations are fulfilled? And suddenly, terms such as deferred revenue, performance obligations, US GAAP, ASC 606, IFRS 15 start entering the quote to cash conversations. We are going to dedicate separate episodes to these topics because they deserve much deeper understanding. But for now, I simply want you to recognize getting the order, generating the invoice, collecting the cash, and recognizing the revenue are not necessarily the same event. That's an extremely important concept for a quote to cash consultant to understand. And there can be many more. And depending on the organizations, our transactions may involve even more teams. Tax specialists may determine how different products and services should be taxed. Customer success may focus on adoption and renewals. Support teams may deliver the service levels we sold. IT and integration teams may make sure all the systems we discussed in the previous episodes actually communicate with each other. And then there may be procurement, treasury, RevOps, product operations, compliance, and several other teams. You don't need to become an expert in every one of these functions. But as a quote to cash or an ARM consultant, you need enough business process understanding to follow their conversations ask intelligent questions, and understand how the requirements could affect the solution you're designing. Now, once again, let's zoom out. We have one customer, one transaction, one quote to cash journey, but look at how differently everyone sees it. Sales is asking, how do I win this deal? Product and the pricing teams are asking, what should we sell and how should we price it? Sales ops or the deal desks are asking, are we structuring the deal correctly? While the credit management might be concerned about how much financial risk are we willing to take? The legal might be asking, what are we contractually committed to? Order management, what have we committed to deliver? Fulfillment, how do we actually deliver it? And the billing team might be wondering, what do we invoice, how much, and when? And the accounts receivable, what does the customer owe us, and have they paid? Of course, there is collections, which might be thinking about why haven't we been paid and what do we do about it? Finance and accounting, how do we account for these transactions currently? And revenue accounting, when have we actually earned the revenue and when should we recognize it? So you see, the same customer, same transaction, completely different priorities. And this is one of the most important lessons I want you to take away from these foundational episodes. A strong quote to cash consultant doesn't just understand the technology, you need to understand three things: the process, the systems, the people. Because when you walk into a requirements workshops, you are not simply gathering Salesforce requirements. You're trying to understand the business. What problem is the stakeholder trying to solve? Why does it matter to them? What business outcomes are they trying to achieve? And how could that requirement affect everything upstream and downstream? When you start thinking that way, your conversation changes. You stop thinking only like someone configuring a system and you start thinking like a consultant. And now we have built our foundation. We have understood the process, the systems, the people. Let us continue building deeper quote to cash and ARM expertise, one concept at a time. I hope you are enjoying these sessions. I'll see you in the next one.